Hello everyone, welcome to the market opening bell for Monday, January 26th, your 10-minute guide to the stock market. Hong Kong stocks followed overseas markets higher on Friday. The Hang Seng Index opened 231 points higher and later expanded its gains to 265 points, briefly reaching 26,895 before closing up 119 points or 0.5% at 26,749. The H-shares index rose 46 points or 0.5% to 9,160, while the Hang Seng Tech Index gained 35 points or 0.6% to 5,798. Total market turnover was 240.8 billion Hong Kong dollars. Southbound funds recorded a net outflow of $1.601 billion from Hong Kong stocks. Among the flows, net inflows went into Pop Mart, totaling 747 million, Xiaomi 608 million, and Tencent 240 million. Net outflows were seen in Alibaba, totaling 1.49 billion, China Mobile 621 million, Yangtze Optical Fiber and Cable 138 million, and Goldwind 123 million. According to data, Southbound funds have bought Xiaomi for 6 consecutive days, totaling $3.073 billion, while they have sold China Mobile for 15 straight days, totaling $11.716 billion. For the week, the Hang Seng Index fell first, then rose, but still landed down 95 points or 0.4%. The Tech Index dropped 24 points or 0.4%, and the H-share Index fell 60 points or 0.7%. Southbound funds recorded net inflows of $23.523 billion for the week, but by net purchase amount, Southbound Capital clearly added to large cap tech names. Xiaomi received the highest weekly net inflow at 2.207 billion Hong Kong dollars, followed by Alibaba at 1.333 billion and Kuaishou at 1.213 billion. China Mobile suffered net outflows of 3.654 billion and has seen holdings decline for 8 consecutive weeks. Technically, with turnover remaining low and northbound and southbound inflows weakening, upside momentum is limited. The market is likely to stay in a narrow range between 26,400 and 27,000 in the near term. Mainland Asia showed divergent moves in the morning session on Friday, but rose together in the afternoon, with turnover increasing from the previous day. The Shanghai Composite closed up 13 points or 0.3% at 4,136. The Shenzhen Component rose 112 points or 0.8% to 14,439, and the Chinex gained 20 points or 0.6% to 3,349. Combined turnover in Shanghai and Shenzhen reached 3.09 trillion yuan. For the week, the Shanghai Composite rose 0.8% and the Shenzhen Component gained 1.1%, marking 3 straight weeks of gains, while the Chinex fell 0.3%, ending its 2-week rally. The renminbi midpoint rate broke through the 7th level and hit a more than 2.5-year high, rising 90 points to 6.9929 against the US dollar. In Hong Kong, solar stocks surged in the afternoon. Drinda New Energy Technology shares rose for a second straight daily limit on the A-share market to 99.44 yuan, a new high since November 2023, while its H-shares soared over 51% to close at $39, a record high. The catalyst came on January 22nd when Tesla CEO Elon Musk, during a discussion with BlackRock CEO Larry Fink at the World Economic Forum in Davos, strongly endorsed space-based solar power and revealed key capacity plans. He said SpaceX and Tesla are simultaneously scaling solar production, targeting 100 gigawatt of annual solar manufacturing capacity within 3 years. Space-based solar power, SBSP, involves satellites equipped with photovoltaic panels collecting solar energy in space, converting it to electricity, and beaming it back to Earth or other facilities via microwave, or laser transmission. Its main advantages are near 24-hour generation, unaffected by day-night cycles, seasons, or weather, with no atmospheric absorption losses. Extremely high energy density. Solar radiation in space is about 13 times stronger than on the ground. Flexible deployment, as energy beams can be redirected to remote areas or islands beyond terrestrial supply. SBSP is being studied for wireless charging of military drones or powering orbital data centers at 800-kilometer altitude. Currently, challenges include reducing high launch costs, improving large antenna assembly efficiency, and mitigating space debris risks. With commercial space launch costs expected to fall in 2026 and surging AI compute demand, space-based solar has become a critical frontier technology for addressing global energy shortages and supporting orbital data centers. If Musk's vision of 100-gigawatt orbital compute materializes, assuming 30% photovoltaic conversion efficiency, it would directly drive demand for over 800 gigawatt of space-based solar capacity, exceeding current annual global terrestrial additions. Meanwhile, after China filed for a constellation of over 200,000 satellites, China's SatNet plans to deploy 13,000 low Earth orbit satellites between 2026 and 2030 and will soon launch tenders, marking the start of large-scale commercial space deployment and long-term demand for space-based solar. On January 21st, Drinda New Energy Technology announced plans to raise funds via H-share placement, with roughly 45% allocated to R&D and production of space-based solar cells, and 45% to equity investments in commercial space, signaling the photovoltaic leaders' formal expansion into aerospace new energy. Market rumors suggest Alibaba has decided to support an independent listing for its AI chip unit T-Hedge. Alibaba shares rose 2.6% to $169.1, established in 2018. T-Hedge develops chips for data centers, AI and IoT, and forms a core part of Alibaba's AI plus cloud infrastructure strategy. Rough estimates based on peer EV to sales multiples and aggressive 2026 revenue assumptions suggest the standalone valuation of 25 to 62 billion US dollars, equivalent to 195 to 483.6 billion Hong Kong dollars, equivalent to 6 to 14% of Alibaba's current market cap. However, the market is likely to discount the rumor given Alibaba's history of announcing and then abandoning spin-offs. Cloud division listing was cancelled in November 2023 due to US chip export restrictions, and Cainiao's IPO was shelved in March 2024 in favor of buying out minority shareholders. On mainland companies listing in Hong Kong, reports indicate the CSRC is considering raising regulatory and compliance thresholds for H-share issuances amid concerns over recent offshore fundraising quality. Sources say one potential measure is a minimum market cap requirement, possibly 30 billion yuan, meaning smaller firms may not receive CSRC registration approval. Companies seeking dual listings in Hong Kong would also face stricter scrutiny. The proposals remain under discussion with no final decision yet. Xtep International released operational data and its 2025 performance report, showing a structural pattern of slowing growth in the core brand but strong performance in professional sports brands. The main Xtep brand recorded low single-digit retail sales growth for the year ended December 31st, 2025, with flat fourth quarter sales reflecting pressure on the core business. Channel inventory turnover was around 4.5 months. Saucony delivered over 30% retail sales growth for both the full year and the fourth quarter. The market expects Xtep's overall revenue growth in 2026 to be similar to 2025, with the main brand maintaining low single-digit growth and professional sports segments, led by Saucony, continuing double-digit expansion. As core brand retail growth slows, Xtep is accelerating its direct-to-consumer transformation to improve efficiency and ease competitive pressure. U.S. stocks traded mixed on Friday after two straight gains. The fear gauge VIX rose 0.45 points or 2.9% to 16.09. The Dow closed down 285 points or 0.6% at 49,098. The Nasdaq ended up 65 points or 0.3% at 23,501, while the S&P 500 edged up 2 points to 6,915. The Nasdaq Golden Dragon China Index, tracking U.S.-listed Chinese stocks, rose 122 points or 1.6% to 7,899. Hong Kong ADRs point to the Hang Seng opening 58 points higher on Monday at 26,808. Wrapping up the week, President Trump expressed interest in annexing Greenland and threatened tariffs on European allies before backing off, triggering a sharp sell-off on Tuesday. Stocks rebounded over the next 2 days but failed to recover Tuesday's losses, leaving the major indexes down for a second straight week. Dow was down 0.7%, S&P 500 down 0.4%, Nasdaq down 0.06%. Intel reported wider losses in weak first quarter guidance, sending shares down 17%. Big tech was mixed. Nvidia rose 1.5% amid reports CEO Jensen Huang will visit China and that Beijing may approve H200 shipments to China, with Alibaba preparing orders. Meta and Amazon gained around 2%, while Apple and Tesla dipped 0.7%. Bank stocks weakened, with Goldman Sachs down 3.8%, JP Morgan down 2%, and Bank of America and Citigroup both off over 1%. On the data front, January S&P manufacturing PMI came in at 51.9, slightly below the expected 52, but above December's 51.8, while services PMI held at 52.5, below the expected 52.9. The final University of Michigan January consumer sentiment reading was revised up to 56.4 from the preliminary 54 and above December's 52.9. One-year inflation expectations were revised down to 4% from 4.2%, with 5 to 10-year expectations of 3.3%. Looking ahead this week, several mega-cap tech names, including Apple, Tesla, and Microsoft, report earnings. Investors will focus on whether heavy capex is translating into real revenue and profit growth to justify lofty valuations. The Fed announces its rate decision on Wednesday and is widely expected to hold rates steady. Silver prices broke above $100 per ounce for the first time, surging as much as 4.2% to $100.29. Year-to-date gains now approach 40% after more than doubling in 2025. The global silver market has been in deficit for 5 consecutive years. Rising prices have drawn rapid retail buying. Confidence in the U.S. and its assets may have been shaken, perhaps permanently, driving flows into precious metals. IMF data showed the dollar's share of global FX reserves has fallen below 60%, a decade's low. A World Gold Council survey found 95% of central banks expect to continue buying gold, interpreted by markets as hedging deep anxiety over dollar credit risk with physical assets that carry no sovereign credit risk. Our stock pick today is Laopu Gold, stock code 6181. Thanks to its unique ancient gold craftsmanship and high-end market positioning, Laopu Gold consistently ranks first among all jewelry brands, including both international and domestic brands, in mainland China for average revenue and sales per square meter in individual malls. In the first half of 2025, it achieved average sales of approximately 459 million yuan per mall. According to Frost and Sullivan research data, Laopu Gold's consumers have an average overlap rate of 77.3% with consumers of the five major international luxury brands Louis Vuitton, Hermes, Cartier, and Bulgari, validating its premium brand positioning. As of 30th June 2025, the company operated 41 self-operated stores across 16 cities, all located in 29 prestigious commercial centers with stringent entry requirements, including 6 SKP centers and 11 Mixi centers. In the first half of 2025, it newly entered 3 commercial centers, including Shanghai Grand Gateway 66, Marina Bay Sands in Singapore, and Shanghai IFC, while also optimizing and expanding its stores in Shenzhen Luohu Mixi and Xiamen Mixi. Although the company primarily focuses on offline sales, during the 2025 Tmall 618 event, its Tmall flagship store topped the gold jewelry category sales chart with transaction volume exceeding 1 billion yuan, the first gold jewelry brand to reach this milestone. During the 2026 New Year holiday period, Laopu Gold recorded double-digit year-on-year growth in domestic same-store sales and triple-digit growth in overall sales, demonstrating the strong appeal of its products in the high-end market. The operational focus for 2026 will be on upgrading store locations and continuing overseas expansion, example Japan and Singapore, which is expected to create new growth drivers. Despite gold price volatility, the company successfully implemented a price adjustment in October 2025 without experiencing significant sales pressure. Management expects the gross margin to further recover to around 40% in 2026. Recommendation: buy at 750 Hong Kong dollars. Target $820. Stop loss $710. I do not hold the above stock.